That's right, 36 trillion lost.
We wiped out $36 trillion of global wealth. We wiped out $36 trillion of global wealth. Global wealth. Global wealth.
So billionaires are freaking out around the world as the Fed and central banks all over the world increase interest rates and tighten the noose around their neck. And this has resulted in markets around the world literally collapsing. In addition, the rising interest rates has caused enormous strength in the dollar relative to other foreign currencies, and this has caused tremendous disruption not only in developing nations but in developed nations around the world. So since the 2008-09 financial crisis, and even before then, central banks around the world have been flooding the market with liquidity and zero interest rates. This has caused financial bubbles to occur all around the world in all kinds of asset classes, and now it's all coming crashing down.
So the chain reaction of Powell's, I'd say, backward-looking data. I mean, you don't have to look anywhere. We wiped out $36 trillion of global wealth in this correction. I mean, that is going to have knock-on effects, not to mention the cracks that are developing in real estate, the construction projects that will be halted, banks loans that can't be refinanced because the banks are freaking out because they don't know where the Fed policy is going to be. At the same time, he's been raising rates. He's liquidating the balance sheet of the country. It's the tightest monetary policy we've ever seen. And the real estate complex, the stocks in the real estate index are back to where they were in the GFC. So the market thinks the world is going to end. And Powell is pretending, and your guest earlier today said, you know, they need credibility. Believe me, they have credibility. They look at the stock market, look at $36 trillion of wealth lost. And we're not arguing that the Fed has to act to bring down inflation, but they should understand where the inflation came from. It came from all those global stimulus packages on the back of a reopening global economy. And it was to the moon and beyond. They missed the meme stocks, they missed the casino. And now that we're building momentum and people are getting employed and wages are rising, now they want to stomp on the whole thing and end the party. And, you know, it's kind of like, I feel like he's the captain driving the Titanic into the ocean.
Investors are panicking. Governments are panicking. The United Nations is panicking. Everybody's panicking over this enormous change in policy that's causing all kinds of unintended consequences. Now, if you turn on CNBC or Bloomberg or any of the financial news channels, you still see a lot of people talking about the Fed backing off or pivoting once the economy starts to weaken. Well, this is starting to happen all over the world, but yet the Fed remains resolute. The Fed so far is resolute in its stance against fighting inflation. And the message is clear. The Fed plans to continue raising interest rates higher and then hold them there until there is clear and convincing evidence that inflation is cooling. And while recession risk has risen, it's not anywhere near their base case expectation and goal of 2% inflation. Some think that there could be worse damage in this situation than the financial crisis of 2008. Wealthy countries could trigger a global recession, the UN just said this week. Governments around the world are determined to bring down inflation, whatever the cost, but a growing chorus of voices is pointing out that aggressive monetary policies could have some serious and long-lasting consequences on the world economy. The world is headed toward a global recession and prolonged stagnation unless we quickly change the current policy course of monetary and fiscal tightening in advanced economies. The UN Conference on Trade and Development cautioned in an annual global trade forecast released on Monday. In addition, the World Trade Organization and the IMF both came out with statements of similar severity. So you can see that the world's central banks' attempt to rein in inflation is not only causing tremendous damage to world economies, but it's also causing everyone to freak out, literally everyone. You can see the extent of extreme political pressure that's already being brought to bear against the central banks of the world as their policy of raising interest rates and tightening credit continues to wreak devastation on the world economies. This is what led a lot of people this week in the financial markets to begin believing again in this narrative that the Fed is going to pivot once the economy starts to falter. That resulted in a brief bear market rally, which I've said on this channel, these intermittent bear market rallies are nothing more than rallies within a bear market, as I believe the overall trend of the market is still down. As I've expressed on this channel before, one of the issues that we see here is that most people alive haven't ever seen an environment like this where the Fed is tightening. We've gone through 20 years of low or zero interest rate environments with the Fed printing money and flooding the market to a greater or lesser extent with liquidity and low interest rates. So as a result, a lot of people just simply cannot process what is happening. Now, it's clear that the Fed is doing something that absolutely has to be done. You can't have in excess of 8% inflation in the economy, and we all believe that it's much greater than 8%. That's an official number, and if you look around at how things are going up, everyone knows the real rate is probably closer to 15 to 20% in some cases. But you cannot have this rampant inflation rippling through the economy. It will just completely destroy the economy over time, and the effects of that are very, very severe. So the Fed has to do what it's doing, but the problem is that really the only tools that they have available to them is raising interest rates and lowering their balance sheet, okay, and not manipulating the bond market anymore, which they're at this point not doing. But, you know, when you do this and when the dollar is the world's reserve currency, all kinds of unintended consequences occur. And I mentioned on the last video, which I'll put up here at the end of this video, I did an entire video about the strength of the dollar and how that's crushing developing nations and also developed nations. Witness what happened in Great Britain a week or so ago. Even though there are enormous intended consequences, and I believe the Fed is definitely going to break something, the Fed has to do it. They have no choice. Their mandate is to keep inflation at 2% and to keep full employment. Like, that's their mandate. That's their job. That's what they're supposed to be doing. So they have to do it. And I think this degree of market freak out with everyone from billionaires who own enormous real estate portfolios like Barry Sternlicht to, you know, the average man on the street that has a 401k or a some kind of an investment account to his name. Everyone is going through the same anxiety. So the unintended consequences of all this: the stock market, as Barry said, lost $36 trillion already, and who knows where it's going to end up. The real estate market, both the commercial and the residential real estate market, are taking enormous hits. They're both undergoing dramatic changes to the cap rates, which are the rates upon which commercial real estate is valued. And I can see how Barry is getting a little bit nervous with his huge real estate portfolio. If things keep going like this, the properties aren't going to be worth the mortgage loans on them. So I can see why he's getting a little panicky, so to speak. But we're also seeing it in the strong dollar's effect on developing markets where they have their debt denominated in dollars. That debt is crashing, and those companies are having trouble servicing that debt because they have to convert their weak currency into dollars to pay the debt service. And we are seeing a lot of devastation both in the bond markets, the US bond market, the British gilt market, and who knows what's going on in the derivatives markets nobody, unless you're, trading derivatives on Wall Street, really understands what's going on there. And there could be all kinds of distortions and all kinds of problems that could result from that. Okay, well, thanks for watching. If you got value out of this, please like and subscribe. I'd love to have you on board for future videos. And right now, it's very important if you would please take a look at this playlist. You'll find a lot of interesting and related topics in there for you to take a look at. Again, thanks for watching, and I'll see you on the next video.